Hi guys, welcome back to SHKExcelWorld. I'm Salim Heather. What
The
happened?
financial model was destroyed due to mistakes in calculation of net present value.
Oh. So guys, this is what happens when you do not understand the concept clearly. And then definitely you will not be able to apply it to practical scenarios for building financial models in your professional career. So it is very important to understand concepts like the time value of money or the investment appraisal methods like the net present value or the IRR method or the modified IRR. So today we are going to talk about how the net present value is calculated in books versus how it is calculated in Excel. So before starting to go to the net present value, let us very briefly talk about the time value of money. So around 4 to 5 years back, the Honda City in Pakistan was worth around 1.8 million rupees and now it is worth 2.5 million rupees. So around 4 to 5 years back, if someone promised you that the person will give you 1.8 million rupees so that you can buy a Honda City in 2021, so definitely you will not be able to do that because the money has lost its worth. So there is a value to the money which erodes over time. So the same concept can be applied for calculating the net present value. And to understand the concept of net present value, let us take a very small example of a business which is to be run for 1 year only. So let's assume that you borrowed money from a bank of around 100,000 rupees at an interest rate of 10%. And the term is that you have to return the principal amount, which is 100,000, as well as the cost of 100,000. So you have a capital of 100,000 and the cost of capital is the interest amount. So you have to return the interest amount, which is 10,000 rupees at the end of first year. So your objective is that you generate enough cash so that you can return the capital, which is 100,000. You can return the cost of capital, which is the interest amount, which is 10,000 rupees, and something is left for you. Let's assume that you generate 115,000 rupees and you will be left with 5,000. So the business is worthwhile and it's viable, you can do it. So this is not a very efficient way of calculating the net value. So the concept comes of the net present value. So you have to bring all of the cash flows from the future years to time zero or in terms of today and then calculate the net value. So we went on from 100,000 to 110,000 by multiplying 100,000 with 1.1 or 1 plus the interest rate and you got 110,000. Now you can again divide the 110,000 with 1.1 or with 1 plus the interest rate and you will get the 100,000 back in today's value. And you can do the same with 115,000 you generated from your business. Divide 115,000 with 1.1 or with 1 plus the interest rate or 1 plus the cost of capital and you will get your present value. And now see in terms of the present value, do you get a positive value in today's time or you get a negative value? So if you get a positive value, then your business is worthwhile. Otherwise, it's not worth it. So let us start today's exercise. But first, do not forget to subscribe to SHKExcelWorld and also click the bell icon. So guys, this is the file we are going to use for today's exercise. You can download this file from the link given below in the description. And in this example, the company wants to take an investment which has an initial investment cost of $210,000 and we are given the 5 years cash flows. So remember we talked about the cost of capital, which was the interest amount in our intro. So in this case it is 10% and first we have to calculate the net cash flows in money terms for each of the years and then we will talk about the present value. So net cash flows, we just add up both of these and copy it to all the cells. So we have the net cash flows for each of the years, and now we will calculate the present value for each of the cash flows. So first we have to define what the divider will be. So this is called the discount factor, and in the same scenario like we divided the first year cash flows with 1 plus the cost of capital, we are going to do the same for each of the year, but since those cash flows are for future years, so those will have an exponential value as well. So first year also had an exponential value of 1. So let us write the cost of capital here. And this is how it is done in books, in papers, because we do not have the Excel there. So first we have to calculate the discount factor equal to 1 plus the cost of capital power or exponential value of the year, because the first year cash flows are to be brought back 1 year back. Now move on to the next one. So the second year cash flows are to be brought back 2 years before. So it should have an exponential value of 2. Let us change the format. And now we can copy it to the rest of the cells. So now we will calculate the present value of the cash flows, which will be in terms of today or present time. So this will be present value, and we will divide the net cash flows with the discount factor, like we divided 110,000 with 1.1, and copy it to all the cells. And now we can add up all of these values, because each of these values represent the present value of the particular year's cash flow. So this is your gross present value, and for calculating the net present value, we will use the cost of investment or the capital amount, which is 210,000. So this is what we invested. This is what we got in terms of present value, and the NPV or the net present value is 9,800. So we can safely say that the business has generated enough cash flows to repay the capital, to repay the cost of capital, and also generate sufficient money that will go into our pocket. So this is how it is done in books, in exams, in papers. So you can use this concept and share it with your friends as well. Now is the time for the net present value calculation for Excel or for financial models. So we have the net cash flows available. Let me reproduce the net cash flows here. So we have the net cash flows here. Now we are going to calculate the present value. We have the discount factor as 10%. The present value. Now we are going to use the formula of NPV equal to NPV. And the rate, we know it is 10%, which is the discount rate or the cost of capital. And the cash flows are all of these. Remember that you should not include the investment amount in your cash flows. Otherwise, your answer will be wrong. So bracket close, press enter. So you can see that with the help of Excel, we have calculated the present value quite easily. Now is the time for the net present value, NPV. We know that we will have to deduct the investment amount from the present value, and we will get the net present value. Now if we change or increase the cost of capital to, let's say, 12%, you can see that when your cost of capital has increased, the project has become unviable and you should not invest in this project. So I hope you have understood the net present value concept quite clearly for your exams, for your accounting, and for Excel as well, because this is how it is used in building financial models. In the next video, I am going to talk about all of the errors, all of the mistakes, all of the disasters we do while preparing the financial models, and the mistakes you should not do while calculating the net present value. So you should definitely see that video, and hope to see you in the next video. Goodbye.